Good evening, everyone, and welcome. I am Divya Gopalakrishnan, and on behalf of CareEdge, I welcome you to our today's discussion on cement, interesting interplay of demand, consolidation, and price elusiveness. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mrs. Sandip Ghose, Managing Director and CEO, Birla Corporation Limited, Mr. Dharmender Tuteja, Chief Financial Officer, Dalmia Bharat Limited and Dalmia Cement Limited, Mr. Jigar Shah, Chief Financial Officer, Wonder Cement Limited. This session will be moderated by Pulkit Agarwal, Director, and Ravleen Sethi, Associate Director, CareEdge Ratings. We will commence this session with a presentation by Ravleen Sethi and Yash Gupta, Assistant Director, CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take the queries during the panel discussion. Now, may I invite Ravleen and Yash to make their presentation, please?
Thank you, Divya. Good evening, everyone. Fiscal of 2024 will be the third consecutive fiscal year registering robust demand growth. The combination of factors like general elections in few states, pollution controls, floods in South India, and construction bans and festivities resulted in a lower offtake in Q3, but we expect the year will close by to 8 to 9% year-on-year growth. Cost battle, which sector grappled with in the last two fiscal, also receded to an extent which has showed up in the improving profitability across the players. Prices, however, eludes even on a strong demand as players have prioritized volumes amid market share tussles. The sector also witnessed capacities changing hands, with few big players taking over the small and mid-sized capacities, which shall consolidate the sector further. Large and mid-sized players remain upbeat in announcing expansion plans. With so much playing out in the sector, we at CareEdge thought that the industry is at an interesting interplay of demand, consolidation, and price elusiveness. And this is an opportune time for us at CareEdge to share our view on the sector through this webinar, and also understand from the experts on how industry is expected to navigate from here on, given the variables which I just spoke about. To set the context for the flow of the presentation, the key discussions will be around the cement demand and the underlying factors that shall drive the same. We will then understand supply-side dynamics and interplay of consolidation with the same. After briefly touching upon the pan-India and the regional utilization levels, we shall move on to the cost and price side of the industry. And we'll then talk about the trajectory of the operating margins and how the credit profile of the players is expected to remain. Let us now have a closer look on each of these. Here we are talking about the cement demand. In Exhibit 1, the blue bars are the total cement demand, and the blue line is the year-on-year growth in the demand. Green line is the GDP growth rate. We have tried to segregate this period into different phases since fiscal of 2015. The phase from fiscal of 2022 to 24 has been remarkable from demand growth perspective, with pickup in housing, pre-election spending, and thrust for infrastructure being the key demand drivers. Demand is to continue the uptrend in the current fiscal, and it should close by 8 to 9% year-on-year growth, with 10% already achieved till YTD of December, despite Q3 being a weak quarter. In fiscal of 24, CareEdge estimates the GDP growth rate to be close at 6.5%, and accordingly, we expect cement demand to GDP multiplier of 1.3 times. However, we expect the demand to moderate from fiscal of 25 to 5 to 6.5% CAGR after 3 years of strong growth as the pace of infrastructure construction cools. It is generally observed that in 2 years leading up to general elections, there is a high cement demand, and then a relative slowdown is witnessed in the subsequent 2 years. Accordingly, cement demand to GDP growth multiplier will moderate to 0.8 to 1x for the next 2 years. We, however, expect, given the thrust on the infra spending, that the pickup post the slowdown in this phase will be faster than the earlier ones. Moving on, let us see the end user segment-wise cement consumption. In general, the end user sector mix in cement industry comprises of housing, which is urban and rural, including the low-cost housing, which is generally 60% of the demand, Infrastructure is 26 to 28%, which has risen from 24% share in the earlier years on the back of government's thrust. And then the industrial share, which is close to 12 to 13%. Though housing remains the largest contributor to cement demand, however, over the medium term, it is expected that the share of infrastructure will expand. And housing growth rate in the total cement demand shall moderate to about 4% over the next 3 years. Infrastructure is expected to grow in early teens and secure close to 32 to 34% in the total demand pie. This is well being demonstrated by the government stepping up the infra budget spend by almost 30% in the last two fiscals. And even in the current interim budget, there was an incremental 11% layout which was announced. And further in the industrial segment, cumulative average growth rate is expected to be around 5 to 7%. The industrial capex is though yet to come at its full pace by corporates, but shall support the overall demand volumes in the medium term. Moving forward, as the demand drivers, we will briefly talk on housing and infra side, looking at the real estate side first. In Exhibit 2, we have new supply, annual sales, and unsold inventory data over the years. This is the data for the top 60 cities in Tier 1 and Tier 2. Over the past 2 years, as it is seen in Exhibit 2, robust sales have been recorded and a steady decrease in the quarter-to-sell ratio, which stood at 8 quarters in 2023 end. The unsold inventory also includes under-construction units, and notably completed units make up less than 15% of the total unsold inventory. Our forecast is that both sales and launches will continue to remain robust, keeping inventory overhang below 8 to 9 quarters. This growth momentum is supported by urbanization, rising income levels improving the affordability, and significant infrastructure development across the country. The growth rate, however, shall moderate from the earlier highs witnessed in last 2 to 3 years on a high base of 2023. Now, under the housing programs of the government, we can see in Exhibit 3, which is on your right, that from the last announced, close to 4 million houses each are pending in the Grameen and urban programs, which needs to be completed by December of 2024. By region allocation of these 8 million houses is given in the chart. And further additional 2 crore houses have been announced in the interim budget for the next 5 years under the rural low-cost housing, which shall keep the cement demand momentum going. Moving to the infra side. Infrastructure will expand its share in the next 5 years with the government's focus on infrastructure spending through its flagship schemes like PM Gati Shakti, rising investments in roads, railways, metros, airports, and the irrigation. Central government's thrust on infrastructure with a plethora of projects in the national infrastructure pipeline and step-up budgets and the state government's effort to increase capex will drive healthy infrastructure-led demand growth in the medium term. The highest traction is expected from roads, and there is a 76% of the target which has been achieved in the phase 1 of the Bharatmala road project. Yes, the end date has been extended to 2028 due to slowdown in the execution in the road projects in the last 2 fiscals. Also, accordingly, in the current slide, there is an update given in each of the key sectors which contribute to cement demand from infra side. And just for emphasis, railway corridors under the PM Gati Shakti have been announced even in the interim budget. Coming to the metro works, in metros, close to 40 to 50% of the total cost is the civil cost. And in Exhibit 5, which is at the right, we have shown region-wise approved, under construction, and upcoming routes to understand which region may see higher demand from this segment. The increase in infrastructure outlay is expected to have a multiplier effect across sectors and set a strong footing for growth and shall keep supporting volumes in cement sector as well. Now, as the sector is having regional flavors, here we have summarized the region-wise and end-user-wise demand drivers. The dark green arrow represents the high demand, light green moderate, and orange represents low. In fiscal of 24, all regions will see good growth, being a pre-election year, but we expect east and central regions to grow at a higher rate, close to 10 to 12%. Both regions have currently lower per capita cement consumption and also on account of number of infra projects. East region will continue to see higher growth despite the high base of last fiscal, largely on account of traction from housing and infra. And center is also better placed as healthy demand is expected from rural housing and infra projects, especially in Uttar Pradesh. On the other hand, demand in the west will be supported by a plethora of infra projects. And southern and northern region will witness relatively moderate growth on a comparatively healthy base of the last two fiscals. However, these regions will still post strong demand growth led by a number of infra and housing projects going under. Now, this interplay of demand dynamics will push the eastern region's share in the overall cement demand consumption to 27% by close of fiscal 2027-28 from the current 25% that it has. Moving on, let us have a look at the supply dynamics of the industry along with the consolidation. Now, improving demand outlook over the medium term and amid the market share tussle which was going on, it has triggered a wave of capacity addition announcements. About 90 million ton is coming by mid of 2025 or FY26 end, and on a long-term basis, the plans are that the total capacity increasing by 140 to 150 million tons, which would be near about fiscal of 2028 or 30. Bulk of these capacities are being added by large players as they have better finance to sustain in challenging times, but mid players have also announced capacity expansion plans. Just for emphasis, in the 6-year period from FY15 to 20, as shown in Exhibit 7, the industry witnessed a similar capacity expansion of, say, about 103 million tons, marginally higher, but demand grew only by 66 million ton in that period, leading to lower utilization levels at pan-India level, excepting the 19, which was a pre-election year. But the period which we've shown from fiscal of 22 to 26, the upcoming capacity is expected to be absorbed with the demand in piping. Therefore, we do not expect declining capacity utilization levels. Our expectation is that the utilization levels will be higher in FY24 and some tapering post that as new capacity comes and demand growth moderates. So utilization should be around 68 to 69% at industry level over the next 2 to 3 years. And this is the grinding utilization that we're talking about. Clinker will be operating at a higher rate. However, any sizable capacity additions will limit a further rise in operating rates. The pace of expansion and demand matching up to it will be a key monitorable that would determine any intermittent demand-supply imbalances. Having looked at the pan-India utilization and capacities, we are now moving to regional utilization levels. In the medium term, the south, east, and northern regions are expected to drive the capacity additions owing to expectation of higher demand growth. Let us look at the northern region first. Utilization in the northern states improved sharply in fiscal of 22 to 76%, and it further grew to 81% in fiscal of 23. With minimal capacity additions during the last 3 fiscals and robust demand growth on the back of government spending and pickup in construction. Now, going forward, demand keeping up with the pace with the upcoming capacity of 10 to 11 million ton in north will be monitorable. In the south, utilization levels have been the lowest. Improved demand from the infra and housing sectors and moderate capacity additions propelled the utilizations to rise to 58% in fiscal of 23. And this will further improve in the current fiscal given the pre-election spending. But it will moderate or remain range-bound amid higher capacity additions in fiscal of 25 and 26 by the players in that region. Moving on to east, pushed by the government for housing and infra made cement players add significant capacity in this region, especially in fiscal of 22, which had pulled down the utilizations to around 63%. However, the sharp uptick was observed in fiscal of 23 and even in the ongoing fiscal to around 70%, and it is projected to remain stable, supported by the robust demand growth potential. Talking of the West, utilization levels is projected to rise in fiscal of 24 with moderate capacity additions and lower inbound cement movement from the South and North, leading to lower cement supply amid rising infra spends. Coming to the central region witnessed marginally better utilization levels in fiscal of 23 amid the strong demand compared to fiscal of 22. In 24, it is expected to remain at 72 to 73%. However, utilization levels are expected to remain range-bound, even though demand potential is there on the back of higher capacity additions by the players in this region. Moving on, let us see how consolidated the sector is. Here in Exhibit 8, consolidation in the sector is shown. The current top 5 players in the industry by capacity, how they fared in their capacity share back in fiscal of 2012, then almost after a decade in fiscal of 2023, and by the end of fiscal of 2025 and 26, what will be their capacity share in the total industry capacity. A similar trend is also shown in Exhibit 8 for the mid and small size players as well. Now, top five players increased their capacity share from 40% in fiscal of 2012 to 48% in fiscal of 2023, 43% of which was through inorganic route. Even the mid-sized players grew their capacity share from 32% in fiscal of 2012 to 38% in fiscal of 2023. However, it should be noted that the top five players enjoy a higher market share of cement volumes sold. So in fiscal of 2012, it was 47% against 40% of the capacity share, which grew to 56% of the volume sold in industry in fiscal of 23, vis-a-vis the capacity share of these top five players being 48%. This showcases that the market share gains by top industry players. Looking ahead, the top five companies have aggressive plans to add capacities organically, which is close to 53 million tons, and close to 26 million tons will be added inorganically, which is shown in Exhibit 9. So in the next 3 years, a higher share of organic capacity is coming on board, which is almost 63% of the organic capacity, which came on board by these large players in a decade time in the past, which is coming up only in the next 3 years in the future. 26 million ton includes the announced capacity inorganic expansions in the current space in the industry, which is JPSS by Dalmia, Sanghi Cements by ACC Ambuja, and Kesoram by Ultratech. Supported by these, we believe that sector is getting consolidated with top and mid-sized players, and as it is moving ahead, this shall help in maintaining the pricing discipline as well. From here on, my colleague Yash will be taking you all through the cost and price elements, along with the fin and the credit profile of the players. Over to you, Yash.
Talking about cost structure, herein all key cost parameters are shown as the percentage of income over the years as provided in Exhibit 10 and Exhibit 11. The raw material cost as a percentage of sales range between 15% to 17%. So not all of the limestone cost can be classified as raw material since major players have captive limestone reserves. Freight costs range between 21% to 25%. However, the costs which have been dominating the current discussion landscape are largely power and fuel costs, which used to be in the range of 18 to 22%, however, significantly spiked to 28% in FY23. Basically, fuel cost consists of coal and petcoke for heating the kilns. Power to run the kilns and cement plants is majorly made through thermal power. However, the industry is inching more towards cleaner energy with each passing year by enhancing waste heat recovery systems, wind power, and solar power capacities. This will not only reduce the carbon emissions, but also reduce the power cost. The total cost per ton significantly shot up post FY21 onwards, largely driven by exorbitant fuel costs and rise in freight costs. Though it has moderated in FY24, it is expected to remain higher compared to pre-FY22, as new normalcy seems to have set in, as we will observe in the next slide. Here, power and fuel cost per ton trend can be seen in Exhibit 12. FY22 and FY23 saw sharp rise in energy costs. However, since November 2022, coal prices started softening as the increase in the supplies of coal filled the demand crunch in the European countries, caused by the reduction of coal imports from Russia. Also, reduced demand in Europe due to warmer winter in calendar year 2022 eased demand pressure. Petcoke and domestic coal prices followed suit. Consequently, we saw the power and fuel cost per ton declining in FY24. However, on account of some high cost of inventory of fuel at the start of the current fiscal year, the full benefit of the drop wasn't realized in FY24. We expect to see further modest reduction in power and fuel cost, however not as low as pre-FY22. Similarly, rise in crude oil prices led to increase in freight cost per ton in FY22 and FY23, but not as significant as power and fuel cost on account of calibrated rise in diesel prices in India. This is depicted in Exhibit 13. Crude oil prices significantly dipped in FY24. However, with limited pass-through by the OMCs in India, the freight cost per ton is expected to remain at its FY23 levels. After the cost, let's see realizations, how they moved. Here, net sales realization trend have been depicted in Exhibit 14. we have observed steady growth in realizations over the past 5 fiscal years through FY23 at a CAGR of 4%. Realization grew by 4% in FY23 year on year. However, it was lower than the spike in the total cost per ton, which was visible in the previous slides. In the current ongoing fiscal year, we didn't observe any sustainable price hike, which can be partly explained on account of softening of fuel costs and partly due to heightened competition amongst players to maximize volumes. At the start of Q3 FY24, industry reported price hikes in various regions. However, large portion of it was rolled back by end of Q3 FY24 on account of demand growth moderation. Considering moderate demand growth expected for FY22 and costs continuing to abate, the realizations are expected to register flat growth or marginal decline. Any supply-demand mismatch in the industry and resultant effect of the same on the prices shall remain monitorable over the next 2 years. Now let us look at return indicators of the industry after we have seen how cost and realizations failed. Exhibit 15 at the top depicts movement of return on capital employed vis-a-vis EBITDA per ton and sales value growth. The chart depicts the capacity utilization at industry level. EBITDA per ton is estimated to move towards 860 to 880 per ton in FY24 versus the continuous decline that we have seen over the past 2 fiscal years through FY23, that is from 1000 per ton to rupees 600 per ton till FY23. Hence, ROCE, which crashed in FY23, is estimated to recover back to 13% in FY24. FY24 had to carry the high cost of fuel from FY23 end, which kept the overall total cost per ton higher compared to the prevalent fuel cost. Hence, we may see a slight increase in EBITDA per ton in FY25 by taking into account relatively lower cost inventory being carried from current fiscal to the next fiscal year. Our assumption is built on the fact that realization shall remain flat. If realizations drop due to any reason, then EBITDA per ton may moderate from the current expected levels. Capacity utilization is expected to be just below 70% in FY25. Moving to leverage across various rating categories. Here, we have built net debt to EBITDA range across top 3 rating brands, that is AAA, AA, and A category over the years. As can be observed, the range of net debt to EBITDA of AAA band players is largely better compared to AA band players, and similarly, AA band players is better compared to A band players. Also, net debt to EBITDA have been largely on a downward trend except for FY23. AAA rated players are operating at a net cash positive position or moving towards it, allowing them to aggressively build capacities over the medium term with modest debt addition. CareEdge rates close to 53% to 54% industry capacity across large, mid, and small sized players. Being a consolidated industry with long-standing and entrenched players, a significant 43% of the rated portfolio is in the AA or above categories. Now, having talked about the industry dynamics and the credit profile of the players, we will now summarize key takeaway points. Credit profile of the players should remain largely stable owing to the strong balance sheets enabling them to carry out capex, particularly by large players with sector consolidation on the cards over the medium term. Though the demand growth is expected to be moderate over the medium term, that is 5% to 6.5% CAGR over FY24-26. Capacity additions is supported by the long-term India growth story. ESG and cost reductions will also be key focus. Key monitorables will be fuel costs, ability to undertake sustainable price hikes, and cement demand and supply mismatch. With this, we come to the end of our presentation. Thank you, everyone. I now hand over to Ms. Divya to take the session forward.
Thank you, Ravleen and Yash, for the presentation. As conveyed earlier, all attendees are requested to key in their questions, which we will take up during the panel discussion. Now, may I invite Pulkit Agarwal and Ravleen Sethi to take over the session, please? Pulkit is a director with CareEdge Ratings. He is a qualified chartered accountant and an MBA and has 17 years of experience in corporate ratings. In CareEdge Ratings, he has led various teams across diverse sectors. Ravleen is an associate director with CareEdge Ratings and is qualified as a chartered accountant and has completed her honors from Hansraj College. Ravleen has over 12 years of experience in the industry with more than 7 years in ratings, and in CareEdge Ratings, she looks after the credits of large corporates and has an expertise in handling diverse sectors, including cement. Over to you, Pulkit and Ravleen.
Thank you, Divya. Good afternoon, all. Now it's time to seek opinion from the experts in the field. Before we start our panel discussion, let me introduce our esteemed guest panel members for today. Our first panel member is Mr. Sandip Ghose. Mr. Ghose is Managing Director and Chief Executive Officer of Birla Corporation Limited, the flagship company of MP Birla Group. In a professional career spanning over 40 years, Mr. Ghose has held a variety of leadership positions in industries ranging from FMCG, media, and cement. He has worked across India and Nepal and played a transformational role in organizations he has been with. Prior to joining Birla Corporation, he was a country sales director at Lafarge India. Mr. Ghosh is a qualified chartered accountant with All India Merit Rank. A very warm welcome, Mr. Ghosh.
Thank you very much. A pleasure to be here.
Our second panel member for today is Mr. Dharmender Tuteja. Mr. Tuteja is the Chief Financial Officer for Dalmia Bharat Limited and Dalmia Cement Bharat Limited. Mr. Tuteja has been working with the Dalmia Group for the last 10 years and has held leadership positions in finance and commercial functions. Before joining Dalmia Group, he was CFO of Indian subsidiary of KHD Humboldt Vedag. Prior to that, he has worked in Central Group, Control and Switchgear, Wipco, and Sales. He has a total experience of 34 years in finance, commercial, and business management roles. He is a member of Institute of Cost and Management Accountants of India and Institute of Company Secretaries of India, and is alumnus of Shriram College of Commerce, Delhi University. A very warm welcome, Mr. Tuteja.
Thank you very much. Look forward to the participation today.
Our third panel member for today is Mr. Jigar Shah. Mr. Shah is a Chief Financial Officer at Wonder Cement Limited and has over 18 years of experience in the field of finance and strategy. Having previously worked for Vedanta Limited and Kalpataru Group, he has a wealth of experience in the manufacturing and EPC sectors. Mr. Shah has rich experience in financial planning and analysis, banking and treasury, accounting, audit, taxation, secretarial and compliance, and internal audits. Mr. Shah is a chartered accountant with a BCom degree. A very warm welcome, Mr. Shah.
Thank you so much.
Let me start today's discussion with Mr. Ghose. Mr. Ghose, as per the CARE estimate, the CAGR growth for cement during 24-26 would be around 5 to 7%. What is your sense on the same, whether it would be around this range, or do you feel that numbers would be significantly different from what is our estimate? And how do you see the demand building up post-elections?
Thank you once again, and for this opportunity to talk to all of you, and very, very, audience, impressive group of people. My own sense is your estimate is, I think, cautiously optimistic. I would see an upside there, provided the kind of economy acceleration happens, which is clearly the stated intention of the government. And at this point in time, there is, I think, reasonable ground to assume that we are going to have a continuity in the government. One is not really looking at any kind of political disruption. but I don't want to do crystal gazing and make any kind of political predictions. But this is from all looks of it. And if that continuity remains, and the kind of vision being articulated by the Prime Minister, um, I would think there are significant chances of an upside. Now, why do I say that? Uh, my confidence arises essentially from two fronts. I think the infrastructure development, if at all, is not going to be just maintained, but if at all, it'll take a further pace. Because from all indications, I would expect that if this government is voted back to power, you will see reforms happening at a faster pace, especially in the areas of land acquisition, the land laws, etc. Because that has been a major, constraint, or that has been holding back a lot of the infrastructural plans of the government in the previous terms. And if Mr. Modi's intention is to really put the Indian economy on an accelerated growth path, this is something they would tackle along with several other reform measures. In the current the last interim budget, there is a very specific reference which many people have missed in terms of aligning the state governments to central policies, and in fact putting an incentives on the table to do that. Now, this is also critical because, in the Indian federal structure, unless the center and the states act in tandem, you cannot get the desired traction. If you see countries like China, the story there has been always that the provinces have played on the same, the same tune, the same strategy pace with what has been the policy at a country level. In India's case, that has been somewhat, you'll find, has been a little disparate. And in states where you've seen there is an alignment, for example, Uttar Pradesh, you have seen very, very rapid growth happening. And again, by indication, if you do have a larger number of states which are aligned to the center, as it is today post the last round of assembly elections, and if this trend continues, you'll find in some of the key states, the economic activity is going to take off in a bigger way. More importantly, some of the initiatives which were already put in motion or in the pipeline in the last two terms of this government. For example, there was a reference to Gati Shakti project. There is the point about the Bharatmala and Sagarmala projects. These things, I think, are going to come towards fruition. And as they come towards fruition, I think that will give a multiplier effect on economic growth. And simultaneously, the government is not going to lose focus on rural development and also urban housing. For the first time, you've had something spelt out very clearly about urban housing in providing, for the affordable housing loans, which are which make it easier for people to invest in housing, affordable housing, and that is how to trigger the growth of housing projects within the tier 2, tier 3 cities. But you'll find, due to better connectivity, for example, the Trans Harbour link in Bombay is going to open up the across the harbour area growth on a very, very fast track. So those are, you'll see those progresses. One is already, I'm back from UP. I was there yesterday. One is already seeing the pickup in economic activity in Eastern UP after the Purvanchal Expressway has come in force, and other, expressways are going to get operational. Now, all these will start, I think, yielding results in the next term onwards. So I am bullish that, though it's hard to, as I said, that I don't want to get into the prediction game or crystal ball gazing, but the economy has to move closer, if towards 10% growth rate in the next 5 years. And if that happens, and even if we take the kind of a low GDP multiplier which has been predicted, I would bank on seeing a higher growth in the cement demand in the coming two fiscals. Along with that, given the nature of this business or the nature of the beast, I would say, in terms of this industry, greenfield projects do take time here. And despite all some of the liberalization which I expect in mining laws, land acquisition laws, and the rest of it, certain things will not change overnight, such as clearance, environment clearances, forest clearances, etc. So a natural lag in the capacity commissioning is, you cannot rule that out. And I think that is something the people who are announcing those major expansion plan have also factored in. So combined between these two things together, I would bet place my money on the capacity utilization, at least in the key geographies. I cannot say the same about South, but certainly I can think of the West and the Central Zone, and also the North areas, capacity utilization being higher than what it is being projected now. So there will be a healthy trend. I'm not therefore predicting a shortage or runaway price increase, but I personally feel that the price increase, the price level will hold, and you're not going to see too much. You'll see normal corrections going up. You're not going to see any kind of collapse in the price table, but you're going to see far greater efficiencies coming both through higher capacity utilization, as well as a lot of the logistics and other efficiencies which are expected to come, say, for example, with the cement corridor, which the government is talking about, though that may not materialize immediately, but there will be some easing on goods traffic due to the freight corridors which are coming in, and which today, therefore, chokes the railway system for movement of coal, movement of food grains in those periods. That will itself ease the movement of cement, and some of those things, the Gati Shakti we talked about, the highways we are talking about, all that is going to also, the real impact of GST in terms of movement of goods has not yet been totally felt by a thing. And industry has not also so far encashed on the, there is, I think, a headroom or a margin left for industry to take out of the logistics costs, which hasn't yet been done. There has been some efforts with, Adani and other large players, and that's where the large player factor comes in. When you have consolidation and when you have larger players, to make some of these structural changes become easier. So the industry will focus much more on cost control, bringing it down. We haven't talked of fuel. With the fuel policy, more and more people are going in also for captive coal mines and the rest of it. So that will ensure margins. So although the prices, therefore, people will not use price as a lever, as much of a lever as increasing profitability, but through the better capacity utilization and cost management, the profitability of the industry ought to be maintained. A last point I would add, if I may, one I'll add on my own, and another you haven't asked the question, but still I would go ahead to add that, is I do not expect, because of this consolidation, any kind of price wars happening. Not because there are the bigger players. You were saying that there is a greater price discipline, etc. Because not because of that, but I think much of the this bogey or created about the consolidation and therefore big players coming into force, I think it's bit of an exaggeration, because in terms of overall structure over the years, yes, you've had just now what is being shown. There has been some changes between the large players' share in the business, but some of those changes are actually cosmetic. Those changes are cosmetic because at that point in time, some of the groups, the consolidation had not happened officially, but they were more or less part of the same group over there. So if you were to go back in time, you will find broadly the split between the large and the medium-sized player. I'm not talking of very small players. They will probably some of them will get taken over, but there is not a huge change in the industry structure as people tend to perceive it as at this point in time. And the last point is this year's performance. This year, this fiscal, I think there has been, if you go back 12 months and see what has been the prediction, had been the prediction of most of the analysts, most of the rating agencies and everyone. Nobody expected a sharp increase in prices. The projections were prices will remain stable, whereas the growth will be close to double digit. And that is where you're ending the year by and large at. What happens is people do get carried away in between by seeing certain monthly aberrations or both positive and negative, and there is a greater enthusiasm thinking that okay, instead of 9 or 10% this year is going to see some 12 or 13% growth. That gets unrealistic, or in some months you find there has been a little price increase, and so you think that is going to sustain. But if you look at the whole year, nobody had originally predicted. And in fact, these ups and downs, or maybe people getting too overconfident and pushing additional stocks in 1 month, some ups and downs in this industry is natural. Nobody had bargained for, the convergence of events between November and December. One is due to elections, but more importantly, this year, if you see the festivals, they came back to back. You had Dussehra followed by Diwali, then you had Chhat, and then you come into the harvesting season, and now the demographics have changed. People from the northern states of Bihar, UP are working across the country in the construction sector. And now when they go back home, they don't come back immediately. And once they go back home there, and if you're just getting into the harvesting season, the rest of it, they stay back. So there is a labor shortage at that point in time. Change of government causes delays in allotting sand and aggregates licenses, and those sort of things get delayed. Now that you're going to have the elections announced and the model code of conduct will come in, that has its impact, because the old contracts, the contractors, they kind of roll up work because they're not sure about the release of payments by the government. So these sort of dislocations happen, but that we have to, that evens out over a period of time. So I would not be, although from the analyst expectation, there may be a bit of disappointment about the performance in Q4 of this year. But looking at the year as a whole, I don't think this year has been bad at all. And if this trend is maintained, I think there is enough for everybody to look forward to from this sector. Thank you very much.
Right, Mr. Ghose. So, as per you, the demand can be even higher than 5 to 7%, what is our estimate, and would be primarily driven by the economic reform agenda of the government. So let me come to Mr. Tuteja. Mr. Tuteja, we have seen that as per our estimates, the infra will be the major demand driver in the cement industry. So if infra becomes a major demand driver, in your sense, will it lead to change in trade and non-trade mix in the industry?
Gradually, yes. Over the period, we have seen that the non-trade segment is gradually inching up slightly, 0.5%, 1% per annum. So I think that once the infra segment increases the total pie of the demand, definitely the non-trade segment will increase, and that cannot be ignored. Although all the big players, they prioritize on the trade segment because of the better margins and better brand leverage. But definitely non-trade segment cannot be ignored, and that will gradually keep inching.
Okay. But will it lead to a significant shift, or it would be a marginal shift in your
Marginal shift only.
marginal shift?
Because housing is not going to give away its giant share of the total pie of the demand. So it will be gradually. Over last so many years, we have seen that infra has moved in spite of such a large impetus by the government. It has moved up only marginally. So the marginal growth will continue.
Okay.
It will not be significant.
Okay. Let me come to Mr. Shah. Mr. Shah, what's your growth estimate for next 2 years, especially in the north and west regions where you are present? And how do you see the next 2 years from the demand perspective?
Sure. So I'll support what Mr. Ghosh has mentioned, that there is no second thought that why the demand will cool down. And all the building blocks, what we can see as a political stability in the country and the growth drivers will continue. However, I'm not so bullish on the growth numbers in terms of the demand. It will definitely be at par or lower than the current year's actual what we'll witness. And I estimate somewhere it is around the 8 and 8.5%, what perhaps you also mentioned in your analytics. So this I buy this analysis that it is around 8 and 8.5%. There is a significant upside possible in India, particularly we are almost half of the global average in terms of the per capita cement consumption. And however, this is the major challenge, what we already asked about Mr. Tuteja also, that we also witnessed that the many large players and particularly backed by the growth in the infrastructure segment. That is many companies and the results what we already witnessed in last for the current financial year for the 9 months ended. Many companies have shifted and they increased the share in the OPC cement compared to the blended cement. And this perhaps as per my takeaway, the trend will continue. Couple of reasons. Perhaps the first reason is the growth in the infrastructure segment and the major projects which are coming up, including the high-speed rail, nuclear power, and the metro or rapid rail in the north and central region. These projects particularly demanding the OPC cement. Though we heard about the off late that the many of the companies they are going for the premium products, but otherwise it is largely demanding the OPC cement. And the second part is that the way we are witnessing these around 100 million all ton cement capacities will going to add in next couple of years or 3 years, maybe some execution lag in the period. Then even if consider that 2.5 years for this and absorbing this capacity addition in the existing market, this will definitely have a pressure on the utilization of the more OPC cement. So companies will tend to move for the OPC cement and will see a considerable shift, particularly for the companies who are largely PPC driven.
Okay, got it. So I would now like to come in over here, and those insights from you all on demand were very interesting. It's good to know that players are expecting a higher demand growth rate than what rating agencies are expecting. So we take the discussion forward, and I would request Mr. Ghose, if you can please share your view first, sir, on the upcoming capacity in the industry. So we've seen players being very upbeat, and they have announced close to 150 to 160 from a long-term perspective, say by fiscal of 28. However, for the next 2.5 years, we see close to 85 to 100 million ton, which may come up. So what's your take, how much capacity will come up? And as I gather your view from your earlier insight, that you are expecting a higher demand growth. So maybe we are not expecting a utilization level to drop and it will hold. But from a capacity perspective, do you see this capacity was likely to come up? Or probably this is more of an announcement to maintain the market share and, amid the tussles, what is going on amongst the players?
Three factors. And we have our colleagues who are from the finance, my colleagues on the panel who are more hardcore. So I've also qualified as a chartered accountant. I call myself a prodigal accountant because I've not done any accounting in the last 40 years. So my colleagues, Mr. Tuteja and Mr. Shah, they can comment on this further. First thing, I believe a lot of the future announcements are based on the India growth story. Sure. And there is every reason for the industrialists to have that confidence.
Hmm.
And international also, there are changes happening with on bigger companies across the globe getting out of traditional gray cement, and all the markets will change, especially in this whole emerging geographies. So there, and with China slowing down, so there will be a lot of changes. So I don't think, therefore, this confidence is misplaced in the longer term. In the shorter term, as I mentioned to you, I think there is a slack built in by most players when they're announcing. One reason for a lot of these announcements, and this is where I would seek the guidance of the colleagues on this panel. I think since there is a lot of bullishness in the markets about the industry, that's a good time for people to announce, and raising funds and other things become much more easier. So this is a good time to make those announcements and move ahead before. So there is a timing issue as well. So while there are obviously certain aberrations possible, those aberrations tend to happen is in a region-wise basis, as we have seen. So it's wrong to see the thing in totality, because cement is really not a pan-Indian business. It depends on the regional play. And so there could be, you can always be off. And that's why I said your own prediction of growth and things, I think that is cautiously optimistic, which is good. And there is no harm in, looking at an upside of a couple of percentages over that. And if that happens, I think we are going to hold. But I think most people, if you see, apart from the just simple capacity announcement, what you're hearing a lot is in terms of costs. What are they going to do on power costs, on logistics costs, and rest of it. So the focus will be very sharply on costs by all the especially the bigger players. Indian cement industry is already, I think, ahead in terms of technology compared to a lot of other countries. It's not realized we're far ahead of China from what it was. You will find far greater international suppliers, global suppliers will be looking at this market in a bigger way. There'll be greater competition, both in terms of getting capital costs down, as well as they're investing more on R&D and the rest of it. So all that, I think, augurs well. So you'll find the thrust will be on cost optimization, both internal and external. You will have high usage of digitization, both in manufacturing, logistics, and the rest of it. So that is where the meat is going to come out in the future. And therefore, to that extent, it will not be as much as volume-based or price-based rather, than what the economies will try to, the juice the industry will try to take out from the cost elements.
Got that. Point well taken, sir. So certain regional aberrations may happen, but from a long-term capacities, they are aligned to the long-term India's growth story. With this, Mr. Shah, I would like to, maybe get in your view, like Mr. Ghose was saying. Can you share your take on the same from a perspective, being a North player? We've seen many players in the recent past have announced capacities in North. And North historically has been operating at the highest levels of the utilization across all regions. So your sense on impact on the capacity utilization in that region, and maybe subsequently the return indicators, say in next 2 to 3 years?
Sure, Ravleen. So one thing is that the capacity addition, or the new capacity addition announced by the majority of players, be it in North or across India, we need to see that how many capacities are backed by the new reserves and resources. Okay.
Yeah.
If it is backed by the same clinker plant or same limestone reserves, then perhaps it is all more difficult, because one side we are saying that the addition of the infra projects and the demand is largely come up with the OPC side further. So that to cater the demand and increase the capacity utilization with the same clinker plants or same clinker resources, then it will be more difficult and for the capacity utilization. Now, particularly for the north, as we witnessed more than 80% in terms of the grinding capacity utilization, and considering the next around 10 million ton odd capacity, which is already announced by the various players to be upcoming in next couple of years, still we considering the demand growth in particularly this region and the large projects which will come up along with the other rural infrastructure growth also. We see that the capacity utilization will still remain on a higher end compared to the other regions.
Okay.
So at least for next at least 2 to 3 years, this can be seen that the utilization level will be similar to the current levels or maybe a percent or so down. Otherwise, it will remain on the higher side only. Or 80% is still considered the healthy capacity utilization. And in terms of the returns, particularly, if you can ask, then return side, definitely that the one that the cycle which we see in the last couple of years when the petcoke prices or international fuel prices were on a peak, the companies resort to the efficiency improvement, and there are a lot many interventions already happened. Focus on the alternate fuels and utilization of the alternate sources of fly ash, which is conditioned fly ash or pond ash. That has resulted and witnessed in the industry the by way of the efficiency improvement. And however, further we can see that the cost will always remain be a focus for industry to compete in this competitive environment, highly competitive environment. And we expect that the margin will remain largely in this range of high teens, currently around 18 to 20% range, provided the petcoke prices or fuel prices will remain at the current levels. So, particularly for the projects which are already installed, we see that ROC will be in the similar range or slightly on the improvement trend when the capacity utilization will improve. However, for the newer projects or the companies where the expansions are going on, they will see that there's some dip in the ROC numbers particularly, because the new investment will take time to harness the results. That is my
Got
take.
that. So,
I'll just
Mr.
add a point,
Sure,
Ravleen,
sir.
if I may. In the north, a lot of the capacity expansion which is being announced are essentially also to cover new limestone mines, because most existing players, the
Yes.
current limestone reserves are fairly stretched. So these are the new areas of Jaisalmer and Nagaur, those areas where people are doing it is to, and I think acquisition of limestone mines would be also relatively easier because of the whole population spread there. And most importantly, you will find due to infrastructure tomorrow, the railway linkages and all in these areas are going to increase. So there is a little bit of banking on the future, which is happening there.
Sure. That's a good insight, sir. Thank you. Mr. Tuteja, I'll just get you into the discussion, though we are all very upbeat about the demand and, but if for any reason the pace at which we are expecting the demand to grow slow than what CARE is projecting, or maybe, vis-a-vis how the players are thinking, do you sense players will put a halt or go slow in putting these capacities? Or do you think, that in the tussle to maintain the market share, the expansion will be there, though at a cost of interim pressures being there on the balance sheet?
Yeah, first, I think sharing my perspective on the demand, definitely
Sure.
the industry players are projecting much better numbers than what you have projected.
Yeah.
And just to share some bit of data, if you see, let's say 2002 to 2012, the economic growth, the GDP growth was about 5.7% CAGR growth. And cement demand growth was 1.5 times of the economic growth, which was, I think, no major surprises by the government, no major disturbances, a normal secular growth of the economy. Then when we take 2012 to 2022, although the economic growth was about more than 7%,
Yeah.
but the cement demand growth was much lower, 4.8% CAGR growth, which is 0.6 times of the economic growth. But this is the period when you got all the shocks like RERA, GST, demonetization, COVID. So when these external shocks came, only then the demand came down. 2023 and 24, both these years, again, you're back to normal of 1.3, 1.4 times of the economic growth. So going forward, we expect that the economic growth should be at least, let's say, around 6.5 to 7%. And cement demand of 8 to 9% growth will come. That is the secular. Of course, a couple of quarters here or there, or 1 year here or there, it can never be projected. But on a secular basis, or let's say 5, 7 years, 8 years, 10 years, you can expect 8 to 9%, 10% growth if India is growing at 6.5 to 7% growth. So with this I don't think the overcapacity is going to create any issues, because whatever capacity has been announced or is going to come is in line with the demand growth. Rather, it is slightly short of demand growth with capacity utilization expected to go up. And if for any reason, let's say 2-3 years consecutively, we get some kind of surprises and demand growth doesn't shape up, definitely the future announcements will get deferred. Once you have already launched the project midway, nobody would like to stop it and make it much more inefficient or higher cost project. But naturally, the next announcement which you're going to make, next expansions, you can always slow down. So there's no fear that if somebody has committed, let's say if India, DCL has also committed that will make about 110 to 130 million. It is cast in stone. It all depends how the economy grows, how the demand growth, and actually people can adjust.
Got that. So basically, if I summarize, maybe, from a player's perspective, we are seeing the capacities would grow at a close to 5 to 6% CAGR. However, we are seeing the demand to be at least 7 to 9%. So
That's
probably the utilization levels shall hold,
well,
and it will be aligned to the India's growth story, correct?
true.
Got that. We just moved to the pricing point. Maybe we'll just gather your views quickly before I pass it on to Pulkit to take up the questions from the attendees. So, Mr. Shah, maybe I'd like to get you back into the conversation. And if you can please help us, price have been very elusive in the sector, and we have not seen much price increases happening, though demand has been very, very strong. So what is your sense on the prices going forward, especially in 25 and 26, when demand growth may taper from the earlier highs? It may remain probably upbeat from what CARE is expecting, but obviously the pre-election year sees a higher demand growth rate, and we have not seen prices increasing even when the cost was very high. So what's your take on that?
Sure. So on a pricing front, what we witnessed that the year when we exited last year, March 23 particularly, and then gradually we have seen that the prices, we able to increase the price as an industry, as a collectively based on the demand supply. And somewhere we see that the price increased in the Q3 particularly. But however, considering these various festivals, back-to-back reasons, elections and everything, and there is a slip in the demand across the regions.
Sure.
And then we witnessed that the whatever that as an industry we have gained in terms of the price increase, that is collectively that is vanished, or it's an elusive kind of thing.
Correct.
And, today we are at such a situation that the almost at the across all the companies, the current prices is somewhere equal to the last year exit prices or slightly below than that price. So that whatever we have gained in this 9 months period, we are back to that last year exit number only. Now coming to the couple of years that we all have a strong conviction about the strong demand growth in terms of say around 8 to 9%. And we also consider that the current utilization level will continue at the similar levels. Then apart from that, the major portion what Mr. Ghose has also mentioned, that the new capacities are coming up backed by the new limestone reserves. We should not forget that the new limestone reserves are comparatively costlier,
at a higher cost.
at a higher cost as compared to the erstwhile that reserves which the companies are enjoying. So considering all point together and to maintain the EBITDA margin in the range of higher teens, even if not with the further increase, then definitely prices should go up. Then only industry as a collectively able to maintain this EBITDA margin. Otherwise, there is a fair amount of chances. And we also need to understand that these petcoke prices are stable and hovering around $120 US dollar petcoke. So that considering the similar fuel levels, the prices has to go up from here at least couple of percentage, 2 to 3%. And last 10 years also averages in India, this CAGR growth of not more than 2.5-3% only in terms of the revenue. So same growth has to continue so that we're able to at least utilize the newer capacities. Otherwise, it will be very difficult for these new capacities to maintain the similar EBITDA margin.
Sure, and the return indicators as
Correct.
well. Correct, got that. So, Mr. Tuteja, moving to you, what Mr. Shah just told us, are your views also similar if we speak on the prices in the south and eastern regions? Because south and east has seen a mixed bag, and you have a significant presence over there. So, from your perspective in these two regions, how is price expected to behave in the next 2 years, say?
Over next 2-3 years, I'll see that prices may remain under pressure. So even in the last couple of years, let's say even 10 years, 20 years, we have seen that the cement prices have increased much lower than the normal inflation rates. So inflation rates have been 4-5%. Our cement price increase would be about 2% CAGR. So, and when the capacity utilizations are low and every larger player, everybody's in a bid to increase their market share, These competitive pressures will not allow the prices to increase significantly, and rather you may see surprises in terms of next 2 years. Demand pressures may put the prices under pressure. So all these young players, I think they'll have to put major focus in terms of cost reductions, be it renewable energy or increasing your alternate fuels, increasing blended cement. All these initiatives will be taking top priority to keep your margins intact or improve. But I think we don't bank upon price increase
Prices.
for the increase of the margins.
Got
Over
that. So
longer period, yes, it may happen, but not in the near future.
Okay. It being a variable probably where, we have a little less control, and cost is the variable where probably players have control.
Focus has to
So
be on internal cost controls.
got that. So maybe taking your thoughts forward to Mr. Ghose. So if you can please help us, recently cost has subsided from the earlier highs it was operating at, and we saw margins for most players bouncing back. But as Yash was also pointing out is in his presentation, it's a new normal, but it is operating at a higher levels from what it was at pre-FY22. So what is your take? Cost going forward, players are working towards, there is a lot of AFR which is happening and renewable resources, as Mr. Tuteja is also saying. But do we see cost volatility to go further down in 25, 26, or probably there will be a significant saving coming up from over there? How do you see the industry landscape changing there, sir?
Ravleen, I mentioned in my introductory remarks that cost will be the main, not only the main lever,
Sure.
but it will be the main foundation or part of the strategy for the industry going forward. Industry is not going to bank on, the whole concept of the industry, the mindset of the industry has changed, Ravleen, from in the last 10, 20 years. Earlier, traditional players, this industry was highly individual promoter driven, smaller units, smaller this thing. When they would bank on these occasional, the cycles of high prices, and then you go down, maybe take the dips, and that is how people used to look at the profitability of the industry. There was focus on costs, but not in the way today cost is being managed in a far more scientific, structured, and in a very, very systematic manner. And newer also, along with that, a lot of technological development is happening. You see your talk, the digitization, we don't put much thought on it. Industry 4.0 can give a huge amount of cost savings to the industry, and bigger players, that is where the bigger players coming in make a difference, because they can then go and take on these big initiatives, which that will automatically cascade down to the other players. So industry has stopped looking at that mindset. Era is gone. I am new to this industry relatively. Most people here have spent some 40 years, 50 years in the industry. I'm not, that way I'm quite a newbie, having spent now only 15 years or so. But even when I joined the industry, people used to look for one quarter of a bumper quarter, which would see them through the rest of the year. Usually this January quarter used to be a huge bumper quarter when you found, prices. I used to joke with an erstwhile CEO of a large company. His birthday used to fall on 3rd of January. I said, we have to every year wait for your birthday to come. That's when the prices took off. So that was the kind of things used to happen. People used to look at this bumper this quarter, or if they were able to sustain the April quarter, the first quarter, it saw you through the year. But that is not the mindset with which people like Mr. Tuteja, Mr. Shah, or their bosses today look at the industry. They are not waiting to see acha kaun sa quarter mein, they will be happening.
Sure.
So that's why cost going to be, the focus today is unbelievable. And not only the focus of the companies, because once the companies are focused, then you will find all your vendors, everybody coming to you, that becomes their selling point. Buy my product, or buy my software, buy my this thing, this will help you control costs. So everybody is looking at that. So that is going to be the major driver, and it's aligned to the national strategy of the government. The focus of this government on supply chain with this Gati Shakti and everything is phenomenal, which is not yet realized because they have identified again for the economy as a whole, including our exports from the country, unless you unlock the logistics efficiencies, the value there, our cost of exports, a large part of it is due to we have put at a disadvantage due to high logistics costs, and that's why all these things are changing. The government's attitude has also changed. I'll again digress for a second. Earlier, we used to have a railway budget 2 days before the main budget, and it used to be a long speech as long as this thing announcing several new trains, this, that, and the rest. This time, have you seen there is just railways covered with just in two lines, and the most important line there is the new freight corridors which are going to be set up, how the Gati Shakti movement. That is the macro level thinking which is happening. And it is going to, help industries like ours where 30% of our, costs come from logistics. That's the mindset change I think all of us have to approach. And last thing, since you asked, it's very difficult to predict what is going to happen in the global situation, whether it's the Red Sea today or another Ukraine or something. But even that, people sail through. They have now that experience. They'll sail through. And in the Indian context specifically, I think after these elections, you'll find much more stability in petrol and diesel prices. And that is going to what you saw in the last quarter, etc. One of the relief was that. That's why logistics costs of all companies did come down in Q3.
Got that, sir. Those were interesting insights. So players have been focusing on the cost reduction, and which also helps them align with their ESG goals as well. Pulkit, you would take it forward for the other things?
Yeah, thank you, Ravleen. So we'll now take up the questions from the participants. Attendees are requested to please key in their questions. So I'll ask Mr. Tuteja to please take up this question. What do you think the impact on cost of the cement due to expenses on ESG area and its subsequent hit on profitability of cement industry?
In our industry, ESG is more profitable. So the line which we say is green is profitable. Sustainability is green as well as profitable. So
right.
Whether it is renewable energy, whether it is alternate fuels, all these things are going to help, or electrical vehicles and the transportation. So all these are going to help. They have a tremendous ROI, and this is going to only help the industry to move faster and faster. And that is one of the reasons that why Indian industry is almost the best in the entire world in terms of the ESG goals. They are already much ahead compared to the rest of the players in the world.
Right. Next question I'll ask Mr. Ghose to please take up. At many places in commercial, industrial and residential projects, prefab wooden and structural steel is replacing the cement usage. Anything to worry on the same, or the volume is too low to hamper the cement demand?
I think it's too early, too low. In my business today, I don't sell any of the other products, but I recall in my previous organization when I was to work for, they had a gypsum board business at that point in time. And the gypsum board sales in India, entire India, was lower than the gypsum board sales in Shanghai, in one city of China. And there are some various things related to it. Once you change, it is not just the material and this thing. With that, you have to get biggest issue is applicators. You have to get applicators trained. The design elements have to change. Everything. So some big constructions will change. Like even today, you will find hotels are not building internal walls. They're doing it with gypsum board or other kind of boards. But those things will change. That is the direction in which the country definitely has to go. But it's so large, our country, you will find that people today even hesitate to go into RMX business because that is still nascent days. Very few people are making any tangible profits in that. So we are, I think, some way off before crossing that bridge.
Okay. For paucity of time, I think this is the last question we will be taking. So next question, I'll request Mr. Shah to please take up. So, Mr. Shah, what's your sense on the consolidation in the industry, which we have seen in the last 2 years? Do you see the consolidation will continue going forward? And if yes, which regions will see more consolidation than the other?
The consolidation will continue. Okay. However, the opportunities available and at what cost, that is a matter for the bigger companies who are in this acquisition spree. So, and particularly when we'll see in the northern space, there are only few companies which are available as a target companies. However, in the other regions, particularly south, there are many such options are available. So, but it's still important at what cost and what's the overall vision by acquiring this organization, by company. This is important for the that will play a key role rather than a quantum.
Okay. Great. So, thank you again to all our guest speakers for their insightful views. It was a privilege to host you, Mr. Ghose, Mr. Tuteja, and Mr. Shah. I will now hand over to Divya to give concluding remarks.
Thank you very much.
Thank you so much.
Thank you, Pulkit and Ravleen, for moderating the session, and Yash for your presentation. Once again, thanking all our guest speakers for their insightful views. It was indeed a privilege to host you. And lastly, thank you to all our participants for taking the time out and being part of this CareEdge webinar. For any further queries, feedback, or suggestion, please write to us in our feedback email. Goodbye for now, and I request the tech team to kindly log off. Thank you.
Thank you. Bye.